The key to long-term survival and prosperity has a lot to do with money management techniques incorporated into a technical system. There are old traders and there are bull traders, but there are very few old bull traders. When deploying the wobble technique, it helps you to get into a trade early, but the question that needs to be asked is what happens when a trade goes against you? I'm very eager to learn about how to manage a bad trade. So as with any trade setup, things can just not go in your favor, right? And you can get yourself into a lot of trouble with some bad trades. So how do you recover? Or what do you do when you're in a bad trade?
Well, I mean, you do the same thing that you would do if you're in a bad trade anytime. You've got to get out of the trade. If it's really going against you, you've got to get out of the trade. You know, with the wobble technique, there's a few ways we can do that, and I'm going to cover those in just a second. But remember, you know, back a minute ago, we were talking about there's a transition period in every trade. A trade where the probabilities are in your favor, and that point where the probabilities now turn against you. And so your job as a trader is to identify that turning point in the market and make sure that your exits are shortly thereafter, shortly after the point where it churns and the probabilities are now against you. That doesn't mean that the trade won't reverse and go back into your favor. That happens all the time. But there is that probability, the probabilities are mounted against you at that point. What do you do then? And that's what we really want to know when we're using the wobbling technique. What do we do at that point when everything turns against us? There's 4 different ways that I'll approach that market. The first is just hitting the close all button, right? I mean, especially if the market is really going against you, you just want to eject. It's like that button in the airplane, you know, they're flying at Mach 8, whatever, and they get hit. The last thing they want to be doing is sitting in the cockpit, right? So they hit the eject button, they get out of the airplane, and you know, and then hopefully they can live to see another day. Same thing in trading, you know, just the eject all, get out of the trade at all costs, just close out. The second thing is sometimes there's a bit of a problem that happens when you use that eject button in the market when you close all. You may have, you know, 15, 20 different trades stacks on, right? You may have a pretty hefty load in the market at that point. And each one of those will be subjective to slippage. And so you may not be able to get out as fast as you want. It may, you know, it's sequentially, the computer goes through sequentially and closes out each one sequentially. That's how programs work. And so sometimes, rather than do that, close out all of the trades, I'll just simply put a 1-to-1 hedge on the books. So instead of being long three stacks, 3 lots of 3 stacks, I'll put short, I'll go in short 3 lots. And now, you know, I'm perfectly hedged. Whatever I lose on the long side, I'm making on the short side and vice versa. And so what that can do is it can buy me a little bit of time to ease out of the market. Another great thing about using the hedging technique, and you know, you got to understand not everybody can use that in the retail world, you know, thanks to the Dodd-Frank legislation and so forth. But the great thing that happens is that it gives you some time. And so if you're not exactly sure that you're at that turning point in the market where probabilities change, using a hedging technique, a 1-to-1 hedge technique, can buy you a little bit of time and let you really know whether the market is going against you at that point. So I often use that if I'm really not sure that, you know, everything's going bad at this point. That's a good technique that a good strategy, good technique that I'll use during that uncertainty time. And then there's two other things that we could do with the wobble technique when we're trying to get out. One is to under hedge it. So rather than a 1-to-1 hedge, we'll take a portion, maybe a third of the position, and hedge a third. So when I'll use that technique in the market is when I'm really, really not sure, but I think that we're going to turn the corner, or maybe I suspect a whipsaw to occur in the market. I'll use an under-ratioed hedge. So I'm long 3 lots, 3 stacks, 3 lots. Maybe I'll go short 1 lot. So now I'll be making 3 times the money if the market turns and moves higher, but I will only be losing one time the money if it goes down, or I'll be 1/3. I'll take 1/3 less of a gain if it goes against me, if that makes sense. So that's under hedging, and again, when I use that technique, it's a really uncertain time, and I'm really worried about the whipsaw. And another way I often refer to that as a trampoline effect, where the market comes down to your support level, to your high probability zone, and then it pushes lower and then just comes racing back, right? That's another time I would use an under-hedged technique. The final technique is an overhedge. We got an underhedge, we got an overhedge. And this is when I'm absolutely confident that the market is just going to keep going down. So what you're doing, you've got 3 longs. I might go 6 shorts. So I'm overhedging. I'm hedging off the losses of my position, but I'm also putting 3 short positions on. And so now when that market gains a little bit of momentum to the downside, I'm actually making money, and I have some time to get out of my longs at that point. That's overhedging. So really, we've got those 4 different ways of getting out of the market. You close out all your positions, you just exit, right? Eject button, we're out of here. The 1-to-1 hedge, you're just basically buying time to get out of the positions. An under hedge, where you're just not sure if this is really the stopping point, and you want to give yourself a little protection to the downside, but you don't want to remove all of the upside opportunity. And then the final one is overhedging, where you're stopping all the bleeding in your original position, and you're making money as the market builds momentum to the downside. So those are really the basic elements of how to get out of these trades in a wobble technique.
That's well, first of all, thank you for sharing that, because it's a very interesting and unique approach that you have with the wobble technique, because I think most times psychologically we think that if we're in a negative position or losing or a bad trade, that's a bad thing, and we shouldn't do this, and we're doing something wrong because we ended up in this position. But understanding that you will be in that position, understanding what to do when you're in that position, and just treating it as this is trading, as opposed to, oops, I made a mistake. No, you didn't make a mistake. It's part of trading.
Yeah, and you're absolutely right. I mean, in most of my wobbling techniques, I'm underwater at some point. That's because the wobble technique is getting me into the trade early, right? The probabilities haven't really formed at that point. We're anticipating, we've got low probability, but that's also the point where we're at the lowest risk, right? If it goes against us. So really what we're doing is getting in early, and I almost expect to be underwater a little bit. And you're right, most people, they don't know what to do with that. They think they get into the trade, they only want to be positive. I don't even look at it that way. I get into the trade, and if it goes against me, I'm even happier. And if it goes against me a little bit more, I'm even happier. At least until that turning point where probabilities shift. And once that probability shifts, then I've got to get out of the trade. But up until that point, it doesn't matter if I'm underwater. It doesn't matter if I'm losing a little bit on the position. You know, I'm using that as an opportunity to build into the big move.
And I would say that learning how to exit a trade correctly, maybe positive or negative, is just a vital part of the technique than learning when to get in, learning how to manage your trades. Would you agree with that?
Absolutely. Again, going back to that point where the probability shift, you know, have I got a 51% chance of this trade forming in my favor, or do I have a 49% chance? You know, and if the probabilities are against me, then I want to start looking for my exits. I need to. That's how you'll be safe for another round of trades in the future. And you know, if you look back in your trading statistics, you look back, you'll see periods of time where you do take those losses, where you do book the losses in the account. But that's okay. There's nothing wrong with that. As long as you can keep those losses small enough that the next trade, the next 2 trades, the next 3 trades, you can climb yourself out of it. And that's the key.
So just to recap, you have 4 basic exit strategies. You have your ejector button, you have your 1-to-1 ratio, your hedging, then you have your under hedge, and then you have your over hedge. And any time during your trading session, you can deploy any one of those strategies.
Any one of them. Yeah, a lot of it depends on how you're reading that price action and how confident you are in the probabilities.
So it would be safe to say that that's something that we should practice a lot.
Absolutely. Every chance you can, every trade. You should be every trade you place, you should be trying to identify that turning point in the market. And knowing where it is half the battle, as they say, right? Knowing where it is half the battle. Managing your mind and your emotions at that point, that's the other half of the battle. But knowing it is, you should know that on every single trade.
1-to-1 hedge, over hedge, under hedge, or just hitting the close all button are all very different exit strategies that can be deployed in any given trading session. For me, the best lesson that I learned is to be patient and wait for that setup to happen. And if your trade turns against you, and it will at some point, using the wobble technique will undoubtedly help you manage your way out of a bad trade.